Jeff, thank you so much for joining us. Jeff is the CEO of SVN SFR Capital Management. He leads SVN SFR Capital Management, which is a private commercial real estate investment firm dedicated to investment in the build-to-rent asset class across the United States. So we are moving from the Gold Coast all the way to the US right now. A very, very speedy move. I believe Jeff is coming to us live from Phoenix in Arizona. Is that correct, Jeff?
Yes, that's correct.
Perfect. Jeff has more than 45 years of commercial real estate experience, including construction, development, and asset management for large-scale commercial projects, as well as managing construction, daily operations, and asset management for several thousand residential multi-family assets. Jeff is a speaker at many of the major SFR, BFR, and CRE industry conferences. In addition, he is co-chair of the National SFR Product Council, a member of the Forbes Real Estate Council, and leads the nation's top SFR, BFR brokerage, data, and research valuation platform. And today, Jeff will be walking us through on Build to Rent, taking the US institutional investors by storm. I'm very, very excited about this, Jeff, and to learn more about what's happening over there in the US in regards to this space. So over to you to share your screen, and please start whenever you're ready.
Okay, thank you very much, Dr. Ashi. I really appreciate the opportunity and the invite from the Crown Leadership International Group to join you this morning for your conference. It's very exciting. I would also like to verbally register my ranking for George's presentation. Very informative, very impressive, but I rank a 5. He did a terrific job. I wasn't able to rank him officially because panelists evidently can't vote, but I just wanted to get my verbal ranking in for sure. So thanks again. It's great to be with you this morning, and you're certainly have a great discussion already going at the beginning of your conference about BTR, and we've referred to that as BFR, Build for Rent. It's also considered Build to Rent. So many different terms that are used both in the US as well as internationally. Today's presentation, I'll be referring to it as BFR, Build for Rent. So it's my honor to be with you today and share the Build for Rent strategies and statistical data supporting really one of the top real estate investment segments in the United States. It's been incredible over the last 4 or 5 years as things have transitioned from other commercial real estate investment segments into the SFR, single family residential investment segment. Crown Leadership has done a really great job of providing you as a delegate today's conference with many options and segments with sessions covering most of the varieties of the elements of Build for Rent, which is exciting, much more extensive than we typically see in the US. So kudos to Crown Leadership International. It's a pretty impressive agenda for today. Although single family or SFR has been a very active investment and segment over the last 12 to 15 years in the United States, it's really expanded with both scattered asset, existing asset, and built to rent investment over the last 2 to 4 years, and specifically during the pandemic. We've assembled for you today the most recent investment segment data, which has been provided to us by John Burns Real Estate Consulting and SFRHub.com, to the leading data and research firms in the United States, and certainly invite you to reach out to them. Dr. Ashi, I'll share my screen. Now we've got a few slides that we can go through this morning. A lot of statistical data that we'll go through. I'll be going through it fairly quickly. Can you see my screen?
Yep, we're all good.
Terrific. Okay, just to give you some context and oversight into the market in the United States for these first couple of slides. As an overall market of current construction and absorption, the US is undersupplied currently by about 1.7 million homes overall. And the price of retail for sale housing has become a larger share of the total annual household income. And I assume that may be happening or starting to happen in Australia and other markets and regions as well. So it's a bigger percentage of your net income or net paycheck, essentially, on a month in, month out basis. Regarding rental homes USA, it's believed the next 5 years will require an additional 7.5 million rental homes. So these are actual rental homes, conventional homes, not apartments or multifamily unit or other asset types, but these are actually homes that families live in. This is, excuse me, this is a 10% above average growth over the last 10 years in the US. So we're seeing quite an impressive explosion, so to speak, or expansion in the US. It's exciting, but it creates all new challenges, obviously, as one might expect. Is a trend here to stay in regards to build for rent? Hang on just a moment. And the answer to that question is most definitely yes. And there's research and statistical data that we're starting to see that really shows us 5, 10, and even 15 years out, the build for rent space will continue to expand at some sort of pace. The SFR BFR investment eclipsed multifamily investment segment in 2016. Now that's a pretty big statement for the United States because always multifamily or apartments has always been the #1 commercial real estate investment segment in the United States for decades. But during 2016, SFR and build-for-rent investment eclipsed multifamily. So that's telling us there's more transactional volume today in the SFR space than there is in the old #1 commercial real estate investment class, multifamily. So that's a major statement and a major shift that we've seen just over the course of the last few years. Over several decades, there's been a huge shift to rental homes as compared to home ownership. So over the last, and it's really been, I'm 66 years old, so I've had the opportunity to really see and experience this firsthand, but really the last 2 to 3 decades, it's become socially acceptable in the United States to rent. Kind of year by year, that acceptance has grown more and more. So we're seeing more and more individuals and families renting than ever before in the United States, rather than owning their own home. In fact, 3 out of 5 living generations today either prefer to rent or at least will consider renting in the United States. Never before, when you look back 15 and 20 and 30 years ago, that was not the case. It was not socially acceptable. It certainly is today. And in many submarkets and regions, it's actually quote unquote cool to rent versus home ownership, which is kind of neat. The most we saw household growth in Q3 at an all-time high, 2021, at about 1.6 million household growth. Now, taking consideration in the United States through last year, there's about 130 million households, of which there's only about 17 to 22 million of those households are actually rental households, depending on the data source that you're reading. And out of those 17 to 22 rental homes that are typically owned by mom and dads or mom and pops, as we refer to them in the United States, only about 300,000 of those 17 to 22 million rental homes are actually owned by Wall Street or owned by institutional investors. So you can see the trend in institutional investing has only just begun in the US in this particular investment class. Okay, so where are the US rental tenants coming from? Now, that's an interesting question, and it has changed so much over the course of the last few years, and certainly the last 2 to 3 decades, as I just mentioned. Here's the answer. This is a great slide. 32% are from attached high-density apartments. So we're seeing multifamily, higher density apartment communities and multifamily communities moving into single-family rentals for many different reasons. There's like 12 to 15 reasons why that started to occur over the course of the last 5 to 8 years. 17% of single-family tenants are coming from previous home ownership. So these are families and or owners that own their home, they've sold their home, now they want to rent a home. So they're choosing to rent because it's socially acceptable and it's a little more mobile. They can make a 1-year commitment to stay in that home with a 1-year lease in the United States versus a 30-year or 10-year mortgage. That kind of gives them a psychological feeling of being kind of anchored down, so to speak. And 43% are from other SFR rentals, whether they may be older vintage homes, or it could be a tenant moving in from another market area or another city. So many changes occurring, and that's why this investment segment is so exciting. You learn so much. It changes every month, every quarter, and it's just one of the most really exciting segments to be involved in today's market area in the US. Okay, that's where the tenants are coming from. What rental product type are they choosing in the USA? So we just learned what type of product they're moving into single family rentals. Where are they coming from? 78%, or the dark blue segment in this chart, are renting single family homes. These are dedicated, conventional, what we call fee simple homes. So separate lot homes, essentially. So you own the land, you own the home, and you own the airspace. So 78% are choosing just a conventional single family home, which is very interesting, compared to 15% in the green segment are choosing attached townhomes that may range in 3 to 8 units. Now, these are still single lot, single land parcel real estate investments where you own the land, you own the vertical home, but they may be attached to 3 to 8 other units within a building, so to speak. And 7% are coming from high density apartments or other product types. So it's super fascinating because these stats have changed so much over the last year, 2 years, 5 years, and 10 years. So it's an ongoing progression into rental housing and has been, as I mentioned earlier, for the last 2 to 3 decades. Considering the past 20 years within the nation, the national SFR occupancy today, of course, is an all-time high because of the shortage that we mentioned earlier at the top of the discussion. And on average, nationally, we're at 96% occupancy. We see several submarkets or several major cities across the USA that are even higher in the 97, 98% range. And if you're in the rental industry, you know, when you start to see 98, 98.5% occupancy levels, that's basically full, because there's still just natural turnover of a few units due to job changes, maybe health issues, or whatever the case may be. There still can be some relocation going on, although minimal. So typically that 98% to 98.5% is really considered full. That's all you can occupy, because you will have a few people moving out for whatever reason it may be. Okay, let's take a quick look at the effective rent forecast across the nation. This is a John Burns Real Estate Consulting specific index that is used industry-wide. This looks at the top 63 markets across the country. And we see here the top 3 dots, or this top growth markets, are in some shade of green. They range from 5 to 7% annual rent growth. Now, this takes in consideration multiple factors in this index, which we won't go into today, but basically it's the dollar per month or annual rent growth for that particular region or city. Now, when you look at these 63 cities, these are all positive rent growth cities across the United States, but there are various degrees. They range anywhere from 7 to 3%. The red is less than 3%. Very few tier 2, tier 3 markets are less than 3%, but there's a few marked on this map. So it's a very robust market, whether you're looking at a large city, medium-sized town, or a rural town or village across the country. We're still seeing rent growth, and have for several years, and probably the last 5 to 10 years. So again, this is really not new information. There's been positive, either neutral or rent growth, really since 1985 in the United States. The investment returns, let's talk about investment. Return on investment for your capital when you buy and invest in single family rental housing, whether it's existing, older vintage scattered asset rental home, or whether it's built for rent new construction. So considering high home prices, strong new lease effective rent, and growth over the last year to 2 years, actually we see rent growth at 5%, value growth averaging about 19% on a national basis, with some markets as high as 12% rent growth and 32% valuation growth. That's very similar actually to Australia, I learned the other day that 2021 per the ABS report showed a valuation, average valuation growth of about 23.7%, of which Hobart, Brisbane, and Sydney, of course, were the leaders from 26% all the way up to almost 30% last year during 2021. So that hit an average value in Australia of about 920,000. So when you compare that, Australian dollars, obviously, but when you compare that to the US, that's about 2/3 higher on average than the average valuation. So your valuation growth and or just net valuations are much higher than the United States typically. So let's take a look at this chart. This is a very important chart. This tells us and shows us we can expect an average, like we mentioned earlier, about 5% lease growth in the USA through 2024. So the next few years, we expect that to continue, but with the current data that we have available today, we can very soundly say we'll see that rent growth through 2024 in the United States. Now, this chart also shows something that's super important in regards to historical data that supports the SFR investment platform. It's probably more important looking back than it is looking forward with this particular chart. It shows us since 1985, which I've been in the industry since that point in time, even before that, but it shows us through the kind of pinkish or brown graph shows us the recessionary periods. So during those 3 or 4 recessionary periods in the United States, since 1985, it shows with single-family rental that the rent growth has either been stable, which typically has been in tier 2 and tier 3 smaller markets, to an actual small percentage of rent growth during the recessional periods. There's many reasons for this that we won't go into today, but it's just really exciting and it really proves and shows through historical data, this is facts, that SFR investment has continued to grow and be very stable, at least according to this chart, since 1985. As you look at other commercial real estate investments, including multifamily, retail shopping centers, office buildings, hospitalities, and others, that's definitely not the case. During economic recessionary downturns, typically in the US, of course, you see, in some cases, substantial decline in rents and certainly decline in valuation. So this is a very important chart that we use day in and day out with the investment sector, just to remind them of the stable nature of single-family rental investment. This will give you an idea, as a result of that stable financial performance over the course of decades, that we've seen recently over the course of the last couple of years, billions of US dollars committed or invested last 2 to 3, 4 years. This group represents more than, just on this slide, more than $250 billion of US dollar investment just in the build-for-rent space. So this does not include existing scattered asset, older vintage home investment. This is just build-for-rent only. So pretty impressive. When you look at the group, and on this slide, it shows the top SFR operators across the country that operates anywhere from 5 to 90,000 homes each, with rents averaging about $1,300 US to $2,000 US. So that kind of gives you some insight. There's multiple, mainly publicly traded groups, but some private investment groups that really have large-scale portfolios and have really mastered economics or efficiencies of managing even scattered asset homes, as well as certainly build-for-rent dedicated neighborhoods. So it's become a very efficient process over the course, really since about 2010 to 2015. A lot of technology has been created and it's become very efficient, not unlike multifamily asset management was prior to that. So, okay, so where is the build-for-rent product and production coming from in the US? Obviously, it's all new construction. And the answer is it's coming from everywhere. So 34% of the home builders product or inventory that originally was dedicated, or that pipeline may have been designed for sale retail or for the consumer buyer buying one home at a time, essentially, and being the primary resident or living in that home. Once they bought it, once they've made that investment, it's been for their home to grow and raise their family. But over the course of the last 24 to 36 months, this has grown through last quarter of last year. Now about 35 or 34% of that home builder's revenue or sales are not in for sale retail products selling to the consumer. It's actually going to the rental, commercial rental real estate investment space. And that's just occurred realistically, really has escalated during the pandemic. So since 2020, started in 2018, 2019 lightly, and then just really grew and expanded during right after the pandemic started in mid 2020. Well, we've spoken today, and the conference actually has a major focus on the Build for Rent or BTR space. What actually is Build for Rent? And this is kind of a trick question, at least in the United States. Build for Rent really covers many different product types that they all get thrown into the same basket and are all the same but totally different when you look at the financial modeling as well as the operating the asset or managing the asset. Marketing the asset, operating the asset, and then disposing of the asset is totally different depending on the different subsectors in the BFR space. But generally, the BFR communities that have accelerated acceptance in the United States and the biggest demand, which are really a solution to affordable housing shortages, tracing back to the Great Recession or back since 2008, 2010, Build for Rent and single family rentals have really been a key solution to that problem, essentially, that started during that major economic downturn. BFR, Build for Rent communities, are typically dedicated, all self-contained rental communities. So if you have a community of 200 homes, all 200 homes are rental homes. Typically, they are what I mentioned earlier, they're fee simple or simple lot or simple one partial lot homes, where the home, they own the land, they own the vertical construction or the home itself and the air rights above that particular home. And all the communities are all rental tenants. So there are some Build for Rent homes that are in for sale communities and sprinkled throughout the communities. But the most common and the most popular in today's market is a dedicated community where all 150 or maybe 200 homes are all rental homes within that community. Much easier to manage. You're with peer tenants or renters or residences within your community. And it's just an incredible and been amazingly accepted concept in the US. The Urban Institute states that the growth in the rental households in the US will exceed that of homeowners by 4 million between 2010 and 2030. Of course, 2030 is not far away, only 8 years. So again, a shortage or an expansion in the rental industry of 4 million over that same period of time compared to for sale purchase homes or consumer homes. Okay, again, kind of expanding on Build for Rent. This is a great slide that expands a little deeper as to what that definition is within the United States. Like I just mentioned, it's typically dedicated community of single family, detached or attached. Walls can be shared, like I mentioned earlier. Typically, that's anywhere from 5 to 8 homes, but units generally cannot be stacked. So when we're talking about a dedicated communities, it may have attached walls on a building with 4 or 5 or maybe 8 units. But typically the units are only 1 or 2 levels tall. So the units are not stacked. It's not 3 or 4 or 5 levels high, which that starts to go into what we call a condo plat. So typically in Build for Rent, the homes are 1 to 2 levels, whether they're detached or attached. Project must contain a minimum of 25 units. We see on average a Build for Rent community, a self-contained dedicated community, typically is going to be in the 80 to probably 150 or 250 home range. On average, we call it within our group at about 150 home average size dedicated subdivision or community of rental homes. Okay, as seen here, let's shift gears just a little bit and compare to multifamily. As seen here, the orange is multifamily high-density apartments, and the SFR rental housing is blue on this particular graph. So SFR is blue, multifamily apartments is orange. The age of SFR, this is really an important statistic and shows you the opportunity forthcoming today and forthcoming in the build-for-rent new construction space. So the age of SFR rental housing stock is older than apartments. So there's a big opportunity for new build-for-rent SFR product. And that's huge over the course of, we believe, the next 5, 10, 15, even 20 or 25 years. So 23% of all SFR rentals were built pre-1950. So pretty old vintage homes. As compared with today, only 17% of multifamily was built pre-1950. So what that's telling us is single family is older vintage. So to grow, it takes new construction, and we'll start to see and already have within the US over the last 10 to 15 years, replacement of older vintage single family rental homes with new construction. So again, that's another layer of new construction or opportunity for build for rent. When you look at land acquisition in various stages across the country, which is really the basis or truly the foundation and kind of the gold bar in the United States is land. Land has been at an all-time shortage for housing development, whether it's for consumer sales or whether it's for BFR, build for rent investment. You find over the course of the last year to 2 years that only about 6 to 7% of the land is being purchased in different stages, specifically by a build for rent builder or developer. Here you show the difference between finished lots, entitled land, or raw single partial land. And of course, as you understand in an investment builder or developer, certainly, that takes different periods of time. So finished lots, you buy the lot, you build a house immediately. So that can be vertical and occupied in the United States within anywhere from 3 to 6 months. Entitled land, that might be a year to 2 years. Raw land could be anywhere from a year and a half to 3 or 4 years, depending on the governmental jurisdiction that land may be located in. So obviously, a lot of pre-planning is required by build-for-rent builders and developers because it can take either months or years to actually bring that project to fruition, not like any other commercial real estate investment asset type, but certainly the same, and really has really put a strain on land within the United States as built for rent has become much more popular in the last 2 to 3 years. It's really brought in new land buyers for all practical purposes into land acquisition that literally didn't exist 3 and 4 years ago. So as a result, you can imagine sky prices, no matter what the stage here on this slide, have skyrocketed over the last 2 and 3 and 4 years, particularly the last 18 to 24 months. Of the active BFR projects in the John Burns Real Estate Consulting database, 51% of the current built-for-rent developments are in submarkets ranked as A, B, or commonly termed as Tier 1 and Tier 2. So pretty major cities across the United States, where only 27% would be rated in D or F zones or submarkets, which typically would be a Tier 2 or Tier 3 market in the United States, which is all good submarkets, but they're just much smaller in their region population. It's estimated that there are approximately about 500 to 700 built-for-rent communities, either in the planning stage or under in the United States. Communities literally finishing and completing and occupying day in and day out. We see that every week within our firm. It's very exciting to track and be a part of that from an acquisition standpoint. Our acquisition firm, over the course of the next 5 to 7 years, will be acquiring about 35,000 built-for-rent homes in about 200 to 250 communities located in about 20 to 25 major markets or cities across the United States. So you can imagine our tracking process that we have really with all projects that we're aware of. You can't really find them all, but we do our best to and track each and every one of them on a quarterly basis. Okay, as I previously mentioned, there's been billions of US dollars that are flowing into this build-for-rent segment. I won't spend much time on these slides, but this will kind of give you the visual image of all the firms that have come into this space anywhere from the last quarter to probably the last 3 or 4 years. Particularly the last 2 years, there's been approximately 30 billion US dollars of investment coming into the build-for-rent space. Many of these groups are household names, both in the United States as well as internationally. Many are publicly traded within the United States and or other countries. And then many are private sector groups. But I wanted to include these slides because it's pretty important that these are big, small, and medium-sized investment groups that are coming into the build-for-rent space. So it's not all huge, what we classify as institutional or Wall Street investors. It ranges from smaller regional investors to mid-scale national investors, and then of course to the larger scale national and public investors. So it's very exciting. Okay, we've talked about the growth and being a very robust investment segment. What's fueling the SFR optimism in the United States? Well, there are many things that have happened, and as we study and research this investment segment, every day we learn something else. And it's just amazing. My background prior to being in single family investment was actually multifamily investment. And this is such a much more exciting investment because it's relatively new compared to apartments and multifamily investment, which in the US has been around forever, since day one for all practical purposes. But this segment is just changing for so many reasons. There's so many shifts, both financially, economically, and socially. And that's what makes it exciting. And we're starting to see this. I'm sure you're starting to see this in your markets, in your countries. But it's truly exciting to watch it and watch it change. And it changes every quarter as you get new statistical data. But what's fueling optimism in the United States? Many different things. Top elements are job growth, obviously is up strongly in most of the major SFR markets, most of the bigger cities. Rising wages, reduction of unemployment, of course, is at an all-time high in the United States as a result of the pandemic. So there have been many pandemic factors that have really fueled the SFR and BFR growth. And we believe those factors will stick, not 100% of them, but the majority of them that have created this robust investment growth, we believe will be here for years and hopefully decades to come. Short supply, which I just mentioned, both on land and or finished product. Rapidly rising home prices, very similar percentage value increases in the United States, as I mentioned earlier in the discussion, to Australia. So it's an exciting space. There's lots of valuation growth, so that automatically brings in additional investment or even new investment. Obviously, rent growth, major contribution to either new investors or expansion of existing investors. With these new lease effective rents and home prices both rising at a solid pace, we're watching lower FHA, which is our government single family home loan program for consumers, will impact the SFR market. So it's going to be much more difficult for the American consumer to buy a home as a result of these government mortgage rate or loan programs increasing the interest rate. And that can push those families out of buying a home to renting a home, because they typically are not a multifamily or an apartment dweller because they have 2, 3, 4, or 5 kids. And you're not going to put those 4 kids in a 2-bedroom apartment or multifamily unit, obviously. So you have to rent a home. You need the yard, you need the garage, and you need the neighborhood and the community and the school system that typically surrounds such a community. So investors are contributing to the rising home prices for one reason I mentioned just a few minutes ago. That's higher land cost, because build-for-rent buyers are a new land buyer into the market. So that automatically has fueled land valuation growth, as well as the end result purchase of that home at certificate of occupancy or at occupancy of that home from a rental standpoint. Okay, so what's 2022 and beyond, what does that look like? Boy, that's a crystal ball question. That's very tricky to answer. But from what we see in participating in this space very actively over the last 5 or 6 years in the United States, we collectively, between our multiple platform group or firms, we really lead the single family and build-for-rent space in the United States. So we have access to an incredible amount of research and data. We're grateful for that, very fortunate. This is what we see 20 and 22 and beyond as a result of just knowledge, experience, and research and data in the space. We believe it's all about large-scale rental home aggregation. All these private and public capital groups that I just showed you 3 slides, those billions, anywhere collectively now about $30 to $60 billion of investment. Taking consideration the average home in the US, average rental home, typically is around 250,000 US to maybe 300,000 US. So each billion of investment typically is anywhere from 3,500 to maybe 4,500 homes for each billion. And we've seen 30 to 60 billion of capital come into the space in the last year to 2 years. So you see what's happening. It's all about large scale rental home aggregation, not unlike our firm. It's aggregating many homes in multiple cities so that you have scalability in each city and you have operating efficiency. So you have a couple thousand or 3,000 homes in a major city, and that gives you operating efficiency through that scalability. So that reduces your operating expenses, increases your net operating income, ultimately using the income method, increases the valuation of that neighborhood and or your entire portfolio. New construction build-for-rent. It's been the hottest thing the last 2 to 3 years in the United States for investment, which has created incredible shortage in the product type and incredible increase in valuation. But at the same time, it's interesting as we have just started to acquire communities, when we look at the rent growth compared to the additional acquisition price due to many different factors over the course of the last couple of years, even with that additional acquisition price, typically because of the local, regional, or submarket rent growth, it still works from a financial investment standpoint, and we expect it to continue for years to come. Top metro areas will be the target, always have been, always will be, although we certainly see in what we classify the tier 2 and tier 3, or the class C and D classes in the previous slide, we see tremendous opportunities. And typically the returns can be higher in those tier 2, tier 3, or C and D markets, so to speak, than the A and B or tier 1 markets. Reason for that, institutional capital typically is only in the tier 1 markets, where mid-range and smaller capital groups really take a hard look and do a great job investment, increase their profitability in the tier 2 and tier 3. It's a high performing sector in both public and private. So SFR Investment, as we saw earlier, is very stable. So that's very attractive to most investment groups. It works during economic downturns, and it also works very well during economic upturns and growth. So that makes it unique when compared to all of the other commercial real estate investment segments. Again, stable and longevity. It has proven over and over and over its longevity, and we certainly believe, this is just a kind of my personal opinion, we'll see this longevity and stability for decades to come in this particular investment segment in the United States. Again, thank you very much to John Burns Real Estate Consulting for being a true leader in the SFR and BFR investment segment for quality data and research. Certainly feel free to reach out at Don Walker here at dwalker@realestateconsulting.com. They really are one of a few leaders within this space across the United States to really acquire data and good research on a day in, day out quarterly basis. And we look to them certainly on a quarterly basis and their weekly reports. Thank you very much. Again, my name is Jeff Klein, and I really thank you for the opportunity to be part of the conference today and invite you to consider SFR and BFR investment in your market area, in your country, in your town, city, or village. Please, if you have any additional questions, reach out to Crown, or you can contact me directly at sfrcapitalmanagement svn.com. And again, thank you very much for the opportunity to share some of this information with you today. And certainly we can open it up, Dr. Asi, to any questions that the delegates may have.
Brilliant. Thank you so much for that, Jeff. As someone who loves data, seeing all those graphs and the heat maps and the numbers, it's definitely something that is very exciting to me personally, being a data nerd that I am. So I will, everyone else, please, if you do have any questions, either use the Q&A chat box or the chat box, whichever one. Please do send your questions so that I can ask it to Jeff. Again, I will start it off. So the one thing that I did have a question to, I love the first thing that you said really struck to me in terms of how in certain regions it's cool to be renting as opposed to actually owning a home. And in Australia, there is still, we're a little bit flipped in that sense, in the sense of there's still the great Australian dream of owning a home, and we're starting to tease out the acceptance of being a long-term renter and that a renting is a lifestyle choice. As opposed to something because you can't you can't afford the place that you currently are living in, and it's a choice that you're actually making because there are a lot of other costs that are associated with being a homeowner that may not be put on if you are a renter. So can I ask, this concept of that social acceptance of being a renter or long-term renting, being in a BFR or a BTR, whichever terminology that we're using, has that sort of been a work in progress for many years that we got to this point? Or has it been something that has, kind of been quickly catapulted because of certain factors in the economy or the society or the demographics, or, like how did that actually come about?
That is a terrific question, and I appreciate you requesting clarification. So the answer to that is very simple. No, the cool factor has not occurred. It's taken 30 years, 3 decades for that cool factor to really evolve, which has really been about 2.5 generations. So it started with my generation being a baby boomer in the very early days. And certainly today with the 2 youngest generations certainly has really evolved and grown, become very robust. I think realistically, the first really major shift was during the Great Recession, during the 2008-2009 recession in the United States. That really kind of forced a lot of renters because of an affordability standpoint. You see a lot of the 2 younger generations in the United States. And this has occurred for many reasons, but one reason is that they may have grown up in a home back in those days, back pre-2008, 2010. They saw their parents foreclosed on because they'd signed up for a 30-year mortgage. In those days, it wasn't unusual to live in your home for 30 years, obviously, grow your family, and be in your home basically forever. But the Great Recession really changed that and became a major shift. And a lot of the 2 younger generations that saw and experienced firsthand that foreclosure process in the US, it's not pretty, it wasn't fun, really put the family into a great financial bind. Really the only alternative for many of those families was renting. So that really created, for the wrong reason, an unfortunate boost in rental housing, starting to become more acceptable socially at that point because it became more common literally day in and day out. But as these 2 younger generations have grown through technology, the changes over the last 10 to 15, even 5 years has just been tremendous. Now we learned over the last 2 years, right, that many of us can work from home. Which we didn't have that element, at least to the extreme or extent we do today. We didn't have that prior to the pandemic. So that's actually added a whole new layer that supported single family and or BFR investment. So I apologize, it's a long answer to your question, but it's a combination of many different factors, but it's been exciting as we've seen it, certainly over the last 5 to 6, 7, 8 years, the cool factor has just grown literally on an annual basis.
Wow, that's amazing. I have another question before I'm monitoring the Q&A as well, and everyone, please make sure that you do ask your questions in the Q&A box. Another question that I had was, in Australia at the moment, there is a lot of teasing on and exploring on to what extent does BTR can assist with housing affordability. And we did see some figures about how much is normally a BTR. I think you mentioned it's roughly between 1,300 to 2,000 US on a monthly sort of basis. Can you tell us how does that compare affordability wise to sort of like the normal private market, I suppose, any rental market that is outside of BFR?
Yeah, great question. Typically, a built-for-rent community, so a self-contained dedicated community in the US. This is exciting because we just received this stat last December at our national conference here, actually in Phoenix in December of last year, Hunter Housing Economics. It's the first time a research group had actually created trending historical data. So what is the differentiation of rent? Is there a rent premium between existing scattered older vintage rental homes versus a built-for-rent dedicated community new construction? The answer to that question was pretty surprising. We knew it was a higher premium, but as an industry, we really didn't have a study or really information or report to really substantiate it. So that was a huge opportunity. I actually opened the conference myself in December and was able to announce this stat with permission of Hunter Housing Economics. But typically in the US, this differs from submarket to submarket. Obviously, there's differentiations in different markets, but that ranges anywhere from $200 a month US to $400 a month US premium rent for a new construction home versus an older vintage investment home that might be a scattered asset in a for sale neighborhood. So that, for the first time as an industry, super exciting that we actually have real data, trending data over the course of the last few years with actual leases, signed, sealed, delivered leases in the built-for-rent communities versus existing asset. So that's really an important stat that we were able to, as an industry, actually have trending history. So now we've started as an industry to really dial that into our performance, to our projections on new construction. And from our firm's standpoint, we try and be conservative. We really take that $200 to $400 a month, and typically we'll slash it by 1/3 to 1/2 just to be conservative until we have continuing statistical data. Which will continue this year and next year, obviously. But that's a very interesting stat. And I can't answer the question, is that relative in other markets within other countries around the world? That I do not know.
So can I just confirm that? So in terms of affordability wise, so if someone was to rent, say, in a BFR dedicated community, would they be renting at a lower rate or at a premium rate compared to those in the private rental market?
Yes, great clarification. They would be paying more money or a premium in the new construction built-for-rent community than an existing asset, older vintage home.
Perfect. Thank you so much. Okay, it looks like I think we don't actually have any questions from the floor. It looks like my questions were the main questions. Okay. And I'm sure it's probably because we're all sort of like still processing the data and all of the information